if the Genius Act passes, coins will be safer than bank deposits by law, which is a place where we wouldn't have expected to be 2 years ago.
All right, here we are with Luca Prosperi, the co-founder and CEO of M0. Luca, it's so great to have you here on The Defiant. Welcome.
Thanks for having me, Cami.
So, I think M0 is one of the most innovative stablecoin platforms out there, but I'd love the founding story behind it. Like, what's your background and what led you to start M0?
Yeah, I'll try to compress many years in a minute or so. So the M0 project was founded by 3 founders. The third one is not with us anymore, but the 2 enduring founders, so to say, that are still grinding are myself and Greg. We met actually in part of the maker ecosystem. Greg was a builder within the maker ecosystem since the very early days, and I had joined the ecosystem during the DeFi summer because I saw the incredible potential of reinventing how money is created. And I was trying to connect the protocol for the first time with the world of real lending outside of crypto, the so-called risk RWA, the beginning of the RWA story, a terrible name. I blame my co-founder for it. Greg, I think, invented it, and it stuck with us. But I think the story was that, we saw the incredible potential or actually having a digitally native version of money that could connect with many, many applications downstream that Maker brought into life. But also we thought that we should have approached the word from a different perspective, more scalable, less gamified, a bit more neutral territory. But our conviction at the beginning of M0 was that digital money, stablecoin, or digital money infrastructure in general would have completely transformed the world. And I think we're seeing this at the very, very early days. I come from finance myself. I'm an economist, mathematician by background. I spent more than 15 years investing and advising financial institutions. So I've known the financial institutional space for very deeply. I used to be an investment banker at Morgan Stanley, a hedge fund manager, private equity professional in other businesses. I always say, for me, it was a blessing in disguise. I got very, very sick in my mid-30s and I had to step out of work to save my life for a year. It gave me a lot of time to think and a lot of time to study what was going on. And I decided to actually jump 100% with a bunch of innovators that were reinventing money in crypto. And it's been the best decision of my life. And here we are. We founded a company. M0 was started in January 2023. We raised significant amount of funding from some of the best investors in the space. I think that we raised so far officially around $60 million of equity from the likes of Pantera, Bain Capital, and others. There is actually something more in the making that we will probably announce soon. And in 2.5 years, we've done a lot. So very excited to be here. In the meantime, the market has actually matured, and this idea of stable coins or digital money that was very nerdy for crypto people like us now is in everybody's mouth. So there is probably a lot of value in it.
Absolutely. What a journey. And so much accomplished in a very short time. Can you go through how the M0 platform works?
Yes, and I'll try to say high level, but we can obviously double click on anything. But the way we are used to stable coins in the first generation of crypto is with the likes of Tether and Circle, right? So they at the very beginning of crypto, they were the 2 main issuers of stable coins. So if you wanted to actually use a digital version of the dollar in the crypto ecosystem, you had to go through those rails. And this was an incredible competitive advantage. We have seen these companies making significant amount of money. And so we have seen a lot of people trying to enter in the space and launch similar projects. We don't think this is the case, right? So we don't think we can live in a future where we have 20, 30 different versions of money with different brands and not interoperable with each other, right? I think they fragment liquidity and they're not really scalable. What we think is something a bit different. We think that money is infrastructure at the end. And so the issuance of money, so who is actually storing the reserves in the real world and just creating a digital version of those reserves, is going to get commoditized very, very quickly. So what we think is most of the fun is actually the infrastructure level. And actually, most of the profits should accrue at the infrastructure level. What does it mean? What do we mean? I think we mean that in the future, people will interact with digital money by seeing balances of dollars, for example, in an application, being like a mobile app or being a protocol or sorts. And these applications will actually use Rails to give the users this experience. And what do the users want? The users want super safe dollars. They want interoperable dollars so they can actually move in and out without slippage to fiat or into other applications. You wouldn't be happy if you send money to Venmo, from Venmo to Revolut, and there is 10% slippage or 1% slippage in between. And they want to have an easy experience. On the other side, the users, the builders, the applications, they want to make sure that they can control everything of the money that they have on their applications. So how the yield is distributed, regulatory compliance, listing, wet listing, interoperability, and many other things. So what we are doing at M0 is actually being this kind of middleware. So we are abstracting away for the developers all the complexities of issuance that others can do at traditional financial institutions. And we are giving a toolkit to builders so that they can control 100% of what the digital money looks in their platform, and without breaking interoperability and liquidity. So example, you are DeFi protocols, I don't know, an exchange or a lending market, or you are an issuer within an ecosystem like Noble and Cosmos. You want to have $1 for that ecosystem, let's say, but you know that to build that dollar requires a lot of work in terms of smart contract audits. You need to create a protocol that allows you to distribute the yield. You need to make sure that there is liquidity for people who want to come from fiat into your dollar, from USDC into your dollar. And you want interoperability between your version of the dollar and many others. M0 allows you to do everything in a matter of days, because you can leverage the contracts. You don't break fungibility. You leverage liquidity infrastructure on chain. You can actually do a lot of funny stuff programmable in a programmable way, and everything on M0. So we joke sometimes internally that we want to be the on-chain crypto version of Stripe. So how Stripe actually has simplified life of a lot of startups that were building, they needed to have like very advanced API tools, payment tools to actually feed their business. We want to do the same for builders. Builders in crypto can use our Rails, our infrastructure to program, do whatever they want with the dollars, bootstrap dollars, launch their own stable coins, only with code, without papers, without agreements with large sales forces or compliance departments, simply in a very crypto native way. And we started early, but with a lot of success. We are already approaching $250 million on our platform with 2 partners live, and we have 10 more partners we already have announced that will come live soon, and 25, 30 more that are knocking at the door to build on our.
Awesome. Well, congrats on that. So let's dive a bit deeper on a couple of things. One of the main pieces for stablecoins is how they are backed. So for M0, do you take care of custodying the assets that are securing these stablecoins? And do you offer all types of collateral? Like, of course, we have fiat-backed stablecoins and also crypto-backed stablecoins. Do you support all kinds? And what kind of infrastructure do you have for that?
No, so at the M0 protocol level, we set the standards, and we have certain proof of reserving requirements. And the standard for the collateral that is backing all the different types of money that are built on top of M0 is the same. And we want to be super, super conservative. So we are starting from the most conservative. So currently, the only assets that are backing M0 dollars are US short-term treasuries below 6 months of residual maturity. Now, what it means is that if you want to be an issuer of those tokens, we require the issuers to have regulatory ability to do that, and then to have reserves that are compliant with the way we see the world, that are approved on chain every day, every 30 hours. So currently, actually, if you go on dashboard.m0.org, you will see that there is an on-chain daily attestation set of all the reserves that are backing it. Now, the reserves are currently in traditional SPV vehicles because there is not an on-chain native version of a treasury, but this is changing as well, right? So we are starting to incorporate some tokenized reserves like Superstate's USDB, for example, and I think that part of the stack will change. So I think that, to make it simple, every money transmitter in the US under Genius Act, Genius is very, very consistent with the way we're looking at the world. So assuming that the Genius legislation passes, every money transmitter under that legislation can actually issue a stable coin that is compliant with the way we see the world. Now, the difference, what I was saying before, is we do not believe in a world where every issuer, every bank wants a stable coin. Yeah, fun, wonderful, but nobody will ask for that stable coin. So we don't think a future with 100 different vertically different stable coins will hold. So we can actually have many issuers that are custodying assets, are issuing stable that are compliant with the M0 ecosystem. And on the other side, builders can take those building blocks and actually program it downstreams in their own environment. But the future where issuance like Tether, they keep 100% of the yield, it's behind us, right? I think the issuance business is going to be very commoditized. But I think that the approach we have with M0 is maximum quality and maximum transparency. So the assets that are backing the stable coins built on the network are super safe, compliant with the appropriate regulatory requirements, liquid, and validated on a daily basis. So I don't think there is any balance sheet that is more transparent than M0's balance sheet, because you can see the treasuries every day at the down to the QSIP single level.
Where are these? Where do you custody or where do you store these funds and treasuries?
So every minter of the M token, so everyone who gives birth to these digital assets that then the builders can embed, needs to be compliant with their requirements, regulatory requirements, and the highest standards. So currently, we have one issuer that is an offshore issuer in the Cayman Islands, similar to many other offshore issuers. The offshore issuers is not an owner of the reserves. Actually, the reserves are held by an SPV, which is a Luxembourg SPV, and the custodian is a German globally systemic bank. So I don't know if the listeners are familiar, but there is like a small group of financial institutions called globally systemic impactful banks, GSIBs, which are the largest banks and the safest banks because they have very, very high prudential requirements. So these are the banks that cannot fail because they're really too big to fail. And there are not so many. There are probably 20 in the world, if I'm not wrong. And one of the banks that is actually storing the reserves for the issuer on M0 network is one of those in Germany. So there is a complete separation of the ownership of the assets and the custody of the assets with the business that is actually issuing. And similarly will happen if there is an issuer in the US as soon as legislation passes. The issuer might be a money transmitter, so to say, so has the regulatory requirement, but they need to custody in a segregated manner the reserves so that the reserves are bankruptcy remote again versus the bankruptcy risk of the issuer. So if the issuer goes down because the business builders are bad at doing business, the state is actually protecting the stablecoin holders by maintaining the reserves. So an interesting situation. Like if the Genius Act passes, stablecoins will be safer than bank deposits by law, which is a place where we wouldn't have expected to be 2 years ago.
Super interesting, especially coming from Maker, which was the original decentralized stablecoin issuer with DAI. It has obviously since transitioned from there, but still wanted to raise this question about decentralized versus centralized stablecoins. You are now in your model. It is a more kind of centralized system with fiat and or like with U.S. treasuries held in a bank. And we've seen kind of the risks of that with what happened to USDC briefly depegging when they shut down these regional banks. So how do you manage those risks?
Yeah, so always the devil is always in the detail, right? So if you look at Circle, for example, the problem of Circle was not the reserves in a bank. The problem of Circle is that the reserves were held as unsecured deposits in a regional bank. So the bank went down and there is no bankruptcy protection for those deposits. And since then, Circle has actually moved towards a safer model where the vast majority of their reserves are treasuries or repo over treasuries. So they were running a very risky model. I actually, I am also a researcher in my spare time. I've been writing a Substack on DeFi called Dirt Roads for many years. I was actually pointing to the bankruptcy risk of SVB a couple of months or a month before Circle SVB blew up and threatened to bring down USDC with them. So I think it was a matter of not great reserving. Interestingly, under MiCA in Europe, the only way you can actually have a stable coin is by depositing between 30 and 60% of your reserves in a bank. So actually MiCA, in order to protect the banking system, is actually enforcing a quality of the coin that is worse for the consumer. they want the consumer to keep bankrolling regional banks, which is disgusting. And that's why not very many large businesses are actually building under MiCA, because they don't want their consumers to risk that a Lithuanian bank goes down and then it brings down everyone. Now, so I think this is the first thing. And Maker, for example, Maker is a decentralized issuer in the name only. What I mean is that the reserves, some of the reserves are actually decentralized, like ETH or Bitcoin, but the governance is not really decentralized. There are like a couple of parties that call all the shots. And actually today, I think half of Maker's reserves are centralized, are traditional assets. So what we think is, more than decentralization, we like to talk about good, credible neutrality. So what we're trying to do is creating a system that is as transparent as possible and tries to avoid single points of failure as much as possible. So creating an infrastructure that can allow the distribution of the reserves through multiple vehicles, the transparency of the reserves on the daily basis. Because we realize that the market, unfortunately, doesn't care enough about credible neutrality and diversification of risk, right? Tether runs one balance sheet, which is completely opaque and nobody cares. And, if Tether goes down, it brings down the entire crypto world with them. So I think that what we're obsessed about is transparency and progressive good faith reduction of risk by diversification. But I like to say, I was very critical about some of the issuers in the early days of stablecoins, but we are seeing a process of increasing quality standards across the board. Even Tether is improving the quality of their balance sheet. Circle has been improving significantly the way they do reserving. And early crypto projects, either they went bankrupt or they've been way more careful in the way they're actually doing issuance. So hopefully this is a trend.
What do you think about the ability for stablecoin issuers to pass down yield down to stablecoin holders? I know, that's been like a key piece of contention in the new stablecoin regulation in the US. Apparently, there's a big lobby against yield being passed down. Which to me seems ridiculous. Like that should be such a huge benefit to stablecoin holders. So if that feature is blocked, how can stablecoin issuers potentially get around that to offer, one of the main benefits to having a crypto stablecoin?
Yeah, so I think there is, in my opinion, there is a commercial answer, technological answer, and regulatory answer. So let's start from the commercial one. Stablecoin issuers pass yield to their distribution partners all the time. So if you look at Circle, and when Circle was publishing their accounts for the pre-IPO, Circle is bleeding the vast majority of the yield to distribution partners, starting from Coinbase. So there is an already issuer to wholesale distributor yield passing activity going on. And it will continue to be so because the distribution partners are those that are creating value and they're really dictating the terms. Now, this is actually, we could do this more programmatically so that if you want to actually participate as a distribution partner, you can do it through technology on a continuum basis without cutting deals on paper, because sometimes if you're not too big, they don't do it for you. So like if you look at Circle, for example, Circle passes the yield to Coinbase, Circle passes the yield to Nubank, Circle doesn't pass the yield to Hyperliquid. Or if you are actually a large protocol that is holding hundreds of millions of dollars of USDC. So imagine if you could do this you could create technology, that's what we're doing, that can actually allow the programmable distribution of the yield downstream to approved parties. You could actually do this with lower barriers and be way more democratic how you share the yield in between players that build the experience ultimate for the user. Now, whether those applications want to share with the end users or not is their decision. I actually think that the users don't care. The reason why we all have money in bank accounts, it's because for us, the easiness of using money in our bank accounts is worth more as a utility of the foregone yield we have on those deposits. So I'm making this very extreme. But what I'm trying to say is that the large wholesalers are way more sensitive than the single user. The user cares about many things: utility, interoperability, the fact that your dollars are accepted everywhere, instead of just a few hundreds of dollars of yield every day. That's how this is the whole predicate of the banking sector. The banking sector is predicated on a spread between what is the yield on your asset and how much you need to pass down to your depositors. There is always a spread in this, and it will always like to be that. Now, what we're trying to do, though, is making this way more democratic. So if you are like a builder, you can actually access the yield in a programmatic manner without lobbying large issuers when you're big enough. And then as a builder, application builder, you can decide from a commercial perspective how much you want to pass down in which form to your users, how much you want to retain for yourself. And this will depend on many different things, right? What type of experiences you provide. But our point is, if you do this with technology, it can be way more transparent, way more fair. So I think ultimately most of the profit will accrue downstream at the distribution level and less at the issuer. The issuer's job of keeping the reserves and just issuing a token is plain vanilla job. It's going to get commoditized. It should make 20 basis points. It shouldn't make 4%. Now, the last point is regulatory. And I agree with you. It doesn't make any sense that if the stable coins are backed by risk-free rate, that the regulation is limiting the passing of those rates to the user, because the risk is the same. Right? So if this is risk-free, why? And I think there are a couple of reasons. First of all, because the Genius Act doesn't want to step over the SEC feet. So they're saying if there is a yield product, some sort of investment product, you don't need to talk to us, you need to talk to someone else. And also is because I think they are trying, and rightly so, I believe, that they are trying to mitigate the disruption risk on banks. Because as I was telling you before, under Genius, stablecoins are already safer than bank deposits. So if I would give anyone the optionality, do you want to keep money in a traditional bank, running the counterparty risk of that bank, that if the bank goes under, you need to pray that they get bailed out? Or do you want to keep money in a digital instrument that is super easy to move around and that doesn't give you any risk? Everybody would say, okay, of course, digital instrument, no question asked. So this is going to create a problem in the banking sector. So if you try at least to limit the yield, you're trying to limit a bit the problem. But the problem is really there. Banks are very inefficient and they're not competitive. So they can try to protect them as much as they want. But at some point, this protectionism is going to stop.
Super interesting answer on the yield side of things. Now, I'd love to come back to M0 specifically. As I understand, there are two stable coins now being built on M0, Noble Dollar and Usual. Can you talk about these two? Like, what are the different use cases? Why do you think they came to M0?
Yes. So the Noble and Usual are the first two partners that they built on us. We have a long list of partners. Some of them we have already announced, and I'm going to mention them later, and some we haven't announced yet. I think we are creating a platform which is completely agnostic. We want to provide the safest, most transparent, most composable way for any financial application builder to embed digital dollars in what they do, whatever they do. And I think when we look through the list of the first 20 builders that are building on us, everybody can recognize how diverse these financial use cases are. So Noble and Usual are two examples. Usual, most people are familiar with, is a DeFi protocol. They grew a lot last year during the mini bull market after the Trump election. Now they're stabilized, but they're still very large. What Usual is doing is accumulating liquidity from their users. They are investing this. They want to invest this liquidity to receive in USDC liquidity to receive treasury rates, and give the ability to the holders of their governance token to have a portion of this. Like they're trying of democratizing Tether, so to say, and just give a piece of it to all their users. Plus, obviously, they're doing a lot more sophisticated stuff. In order to get the treasury rate, they started by partnering with a T-bill tokenizer called Hashnote that was subsequently acquired by Circle. Hashnote was is still providing a Web 2.5 type of product that was tokenized, but it was not super liquid and it was not composable with DeFi. So what we did for the guys at Usual, when they wanted to diversify the reserves, we created an extension for Usual of the M dollar, which is the let's say the wholesale stablecoin that is produced by M0 protocol. And they can do a lot of stuff. So they can receive yield on a continuum basis. They can decide where this yield goes. It's liquid versus USDC in the case they need to move out of their own reserves into USDC to manage the peg across the different liquidity protocols. So it's a very crypto native Web3 product. It's programmatic in nature, can be improved with time. It's super safe from an audit perspective, and it's very, very liquid against USDC, which is their reference peg. The Noble is a bit different, which I think is even more interesting. So most people know Noble because Noble was the issuer of USDC in the Cosmos ecosystem. So there is a big ecosystem in cryptos in Cosmos. Cosmos used to have Terra as their reference stablecoin. in a different era. And then obviously most of the usage of stablecoins gravitated around USDC. So at some point, the Noble team came to us and said, okay, we actually are doing so much heavy lifting for Circle. Happy to keep doing it. It's a big client. But why don't we launch ourselves the reference stablecoin of the Cosmos ecosystem? Now, we know the market. We can work very, very close to the distributors, but we don't know how to build a stablecoin from a smart contract reserving perspective. And also, we need the rails to be very, very liquid, because our users will come with USDC. We need to be able to swap very quickly. We need to be able to redeem them very quickly in case they want to get out of the Cosmos ecosystem and come back on mainnet, for example. And so we partner. We have known Stefan and Jelena for a while. The guys are awesome, and it's a great team. And so the way it works is the Noble team, if you want to purchase Noble Dollar, you come with USDC or with fiat through a ramp. Behind the scenes, actually, the protocol programmatically sends USDC into mainnet, into a Uniswap pool, acquires programmatically the M token, which is this wholesale stablecoin produced by M0, wraps this M token as part of the reserves of a Noble Dollar, and creates additional features for it. So, for example, how the yield is distributed, etc. So they work on the distribution side, but all the technology behind it in terms of liquidity, interoperability of the token, bridging, and in the proof of reserve, how the yield is distributed downstream is done by M0. So in doing this, they do not break fungibility. So if they need to go back to USDC, they unwrap their dollar into the raw material, and then they can swap. And I think this is a very good example of what we can do. Like, we will build the building blocks, the interoperability, liquidity layers, and teams that are very focused on distribution or creating cool products. They can wrap this token, add additional features from brand to yield to blacklisting, whitelisting, and curate their downstream distribution. We think this is the future. And if I look along like the list of people building on M0s, we mentioned Noble, we mentioned Usual, but we have Playtron. Playtron is creating the Game Dollar, which is a global dollar for their open source gaming ecosystem on Sui. They're building it on M0. So they will curate the experience for the consumer, but the behind the scenes middleware is entirely M0. We have Spree, Superlogic. They're trying to experiment with stablecoins. They are one of the largest companies doing awards and points programs in the US. We have Cast. Cast is a neobank credit card provider, which is entirely crypto-backed. We are working on Solana to provide the infrastructure for the digital dollar behind the scenes with M0. And we have a long list of other partners, probably 30, 35. They're doing the same on Arbitrum. So I think that the idea here is, you know your customers, you're building financial applications. We are your bedrock, super safe, super programmable from a technology and reserving perspective. Keep evolving with you. You keep most of the money because you do most of the heavy lifting with your clients. And we just want to provide the most open architecture, open source alternative to actually for you to master the dollars on your stack.
And it doesn't matter which chain?
It doesn't matter which chain. I think we are expanding. We are very close to the Wormhole team. So we have been working alongside the guys to make this as omni-chain as possible. We are working with other providers. We are working on our own solutions because we want this to be as interoperable as possible. So we exist on mainnet. We exist on EVM chains. We exist on optimistic rollups. We exist on Solana. We will exist soon on Sui, and we keep expanding our footprint.
About interoperability is obviously there's interoperability within the M0 network of tokens, but what about with the stablecoins and tokens outside of it? Does that break down a little bit?
I think we believe in a hub and spoke model. Let's say, example of Noble. If Noble wanted to be super liquid and super interoperable themselves, they needed to build all the network around the Noble Dollar. Now, what they need to do instead, they can focus on the last mile. So, for example, Noble has a pool on the Noble chain against USDC, which is small. And when they need interoperability or liquidity in bulk, they can unwrap, go back to the raw material, and go back, as you were mentioning, within the M0 ecosystem. So I think that we believe in a hub and spoke model where we will create the behind the scenes wholesale level interoperability for the reserve that is backing all those tokens. And then, some of those extension of tokens, they become very, very big. they will most probably build their own interoperability network, but it's going to be a composition of the two. We are we are DeFi natives, we're crypto natives. We believe really in the power of composability of different projects, different protocols doing different things at different level of the stack. So we want to leverage them. Like even on liquidity, we are building some solutions to make the liquidity within our system more efficient. But we build also on top of Uniswap, right? So we have a pool on Uniswap v3. We were one of the first builders building on Uniswap v4, more sophisticated liquidity pools, and we will keep partnering with other protocols we are both building with other protocols for blacklisting, whitelisting, compliance features to embed within the M0 ecosystem. So it's always a call to action for people that are building very cool stuff that are useful within the stablecoin ecosystem, actually to build together with us.
How does M0 compare to other stablecoin platforms? Like Paxos is the big one that comes to mind.
I think Paxos is, and I mean, I don't want to say anything bad with the guys, because I think the guys have been extremely successful and they were from a different generation. So they're also learning how to approach this next generation. I think Paxos started as a fully vertically focused like stablecoin builder. So like if you're PayPal, you want to have your own stablecoin, Paxos would offer you a compliant way of doing it to keep your reserves. That would create like the technology for you. But then you would have a PayPal dollar, and you need to create the network around your PayPal dollar yourself, right? I mean, the liquidity, the acceptance network, and everything. So it's more it is an old school approach, which is good for companies that are obsessed with control and they want a silo, but then they realize this silo is not very useful, because the beauty of the most useful thing of money is interoperability, the fact that your dollar is accepted everywhere. So we are actually way more horizontal. So we are creating infrastructure that can aggregate standards, aggregate liquidity, aggregate technology, and can allow like a network of assets. But we're also seeing that Paxos is going in that direction, right? So they issue the global dollar, which is a consortium of parties where there is interoperability within that consortium, which is a closed loop Web 2.5 version of what we're doing. But we know for a fact that the guys are looking with curiosity about what we're doing, which is a more crypto native. Who knows? Maybe we partner at some point. I think that we are coming from like a more deep infrastructural crypto friendly way, and the guys are coming from more from a corporate standpoint. But most probably, if you are a very large bank in the US and you want to issue your own stablecoin, you're obsessed about control, you wouldn't contact M0. You would probably go to Paxos from a positioning perspective. But if you're hyper liquid, you should come to us. It's just like a different.
Got it. Perfect. Okay. Last two questions. One is the main kind of, I guess like Paxos does a very similar thing to what you're doing, but kind of philosophically in a more kind of long-term vision of what you want M0 to be. Are you going after today's biggest players? Like, are you hoping that the next Tether comes from M0, or that the next USDC comes from M0?
Yeah, I think it's is more than that. I think that in the future, the tech business will become also a fintech business. Every front end manages money will be built on stablecoin rails. 15 years ago, 10 years ago, fintech businesses had a partner bank behind the scenes, right? So the front end was sleek, was very cool, but behind the scenes, the storage of money was a very antiquated financial institution, which was cumbersome to do and also risky. But we are convinced that the new generation of fintech entrepreneurs, people that build cool financial products, will build on stablecoin rails, and we want to be those stablecoin rails. So we actually want to be the infrastructure that powers the future, the next generation of financial technology applications worldwide. So we will be larger than Tether. As a project, we will not make as much money as Tether, because I don't think it's healthy. I think most of the money should actually go downstream to people that are building cool products and attracting great customers. The difference is that we want to build an infrastructure which has a low cost to maintain, because it's built on permissionless, immutable rails in crypto, so that our profit margins are still profit margins of a successful project. But I believe that the future for M0, of a successful M0, are hundreds of billions of dollars existing on the platform, where the vast majority of the profits are actually accrued programmatically by a great team businesses that they're built on top of our rails and make most of the heavy lifting for their customers.
That's a really exciting vision. Okay, so I wanted to ask you about the M0 long-term vision, and then to wrap up, I want to ask you about just the stablecoin more broadly long-term vision. Like, I guess you kind of answered that in your previous question, but more explicitly, do you believe most of money movement will happen on stablecoins? I mean, with stablecoins and on stablecoin rails in the future?
I know, and not only movement. I think most of money activity in general, even storage. I think we are, and obviously I'm very bullish as a builder. You need to be, right? I mean, you build the future you believe in. You don't wait for people to build it for you. But I think we are at the beginning of the most impactful financial revolution of our lifetimes. And we are completely redesigning the way money has been created and stored and manipulated, that before was the monopoly of commercial banks. And finally, technology is entering this business. So I think the vast majority of money applications will run on those rails in the future. Currently, it's $220 billion. It will probably be $2 trillion in, 10 years' time. Who knows? But this is going to be cross-border payments is the tip of the iceberg. I think any financial use case could be built on top of those rails. We did a campaign. We started a campaign, our first mass campaign, like a week ago, with a video that was saying, like, in a very catchy way, but also controversial way, that everything is a bank, because everything is actually embedding financial use cases, and there are banks behind it making the money out of it. Because we wanted to point the system that the financial intermediation can be way more distributed in the future. And I took the time to write a manifesto in the same web page that, as usual, nobody reads. But I think it's important for me is that I think we are at the forefront of, at the beginning of a massive shift of how money is manipulated and designed. We're just disassembling the monopoly of massive financial institutions, and we are just recomposing those use cases across a way more distributed with this. So it seems cheesy. We have something we have discussed in crypto for a long time, but I believe in it because it's a long process. Is DeFi crypto rails are going to do with financial intermediation what the internet has done to publishing businesses, and this is just the beginning.
Awesome. No, really exciting vision, and it's a great time to be a stablecoin builder. So kudos to you, and again, really great to see all the progress you've made in such a short time. And yeah, it was so great chatting. Thanks so much for a really interesting conversation, Luca.
Thanks for having me.